Asset turnover is a key financial ratio. It tells you how effectively a company uses its assets to generate revenue. Think of it like this. Assets are your tools and revenue is your output. A higher asset turnover means the company is using its tools more efficiently to produce more output. It's like a baker using their oven to bake more loaves of bread in a day. To calculate asset turnover, you divide a company's net sales by its average total assets. Net sales represent the revenue generated from the company's core operations. Average total assets are calculated by adding the total assets at the beginning and end of a period and dividing by 2. This gives you an average value for the period being analyzed. Asset turnover varies significantly across industries. Industries with high asset turnover, like retail, tend to have lower profit margins. They rely on high sales volume to generate profits. Think of a grocery store with a constant flow of customers buying essential items at relatively low prices. In contrast, industries with low asset turnover, like manufacturing or utilities, often have higher profit margins. They may sell fewer units but at much higher prices. For instance, an airplane manufacturer sells fewer planes but at a significantly higher price than a grocery store sells loaves of bread. Companies like Walmart, known for its high sales volume and efficient use of assets like its vast network of stores and supply chain, typically have high asset turnover. This means they generate a lot of revenue relative to their assets. On the other hand, companies in capital-intensive industries like utility companies that require substantial infrastructure investments tend to have lower asset turnover. They have a large asset base but generate relatively lower revenue per dollar of assets. Understanding asset turnover is crucial for both investors and company managers. Investors use this ratio to assess how efficiently a company is using its resources to generate revenue and profits. A high asset turnover can be a sign of a well-managed and profitable company. For company managers, asset turnover is a key performance indicator. It helps them identify areas for improvement in asset utilization, potentially leading to increased profitability. By tracking this ratio over time, managers can identify trends, make informed decisions about resource allocation, and ultimately drive business growth.